Alrighty, good morning and welcome traders. It is Saturday, January 20th, 2024. This is going to be the recap video for the week ending January 19th here. But I really want to focus today on investing versus trading, and we'll talk a little bit about hedging and what the differences are between investing and trading. So I kind of wanted to just throw that out to begin with. Then we'll just get into what we normally do here, and we'll explain why I'm talking about that. So let's get into it. But there are some pretty significant differences between investing and trading. What I want to make sure that you guys understand is what's your goals for your account? Because there's a lot of talk about hedging out there. My friends in some other Discords, Sweet Bobby and Brian, Ed, do a great job with what they're communicating. But I want to make sure too, I'll throw Lance in there as well. So a really good job talking about hedging and making sure that people aren't over leveraging. And we do talk about hedging here to an extent. We just look at things a little bit differently maybe than some others out there, because I want to really make sure that you understand when you're trading what the difference is between, again, trading, okay, and hedging, or hedging and investing, I should say. So investing, fairly simple. I mean, we're investing really for the long term. It's a lot more passive, not really very active trading. Maybe it's a lot more buy and hold, and maybe you're using some sort of mutual funds, VOO or SPY. Maybe you've got some blue chip companies. Maybe you've got some dividend growth, what have you. That's all good. And maybe some of those investing stocks, pay dividends. You start to think, when I'm investing, I start to think a little bit more, Warren Buffett style, and Berkshire Hathaway, and what is he buying? And it's Apple, and it's Coca-Cola, and it's insurance companies, and big, solid, strong companies that I'm investing in. It's a lot less risky. You can start with any amount of money typically, and you just slowly build those piles up over time. And I think when it comes to investing, in a lot of times in my head, I start to think about our IRAs and things like that. And then you've got trading. And trading is what we primarily do in the Income Navigator service, is we're working on trading. Trading is a much more difficult skill set. It's much more difficult to implement, requires a specific strategy and a plan for that. You're trying to outpace the market, whereas if I'm investing, I mean, we certainly don't want to trail the market, but a lot of times we're benchmarking the S&P, and we're trying to match or beat the S&P in these mutual funds or in these annuities or IRAs or whatever you might be doing. And in trading, that's just not the case. I don't benchmark the S&P because I have no desire, okay, to care really what the S&P is doing. Okay, I need to hit my goals. Okay, I don't care if I'm beating it by 5%, 2%, 20%, 50%, doesn't matter. All that matters to me, when it comes to my trading accounts, is hitting the numbers that I'm looking for. It's typically going to involve taking on a bit more risk than your investments do. You may have a little bit more money required in many cases to start investing versus trading. But in many cases, I think you can start investing with $100, but trading, you really got to have a couple $1,000s, I think, to really start doing anything of value out there. So what I want to talk about briefly is what's the difference between investing and trading when it comes to the way we trade and our accounts here. And there's a big difference in the way I handle accounts and what I'm shooting for. I'm running a trading account. We started this trading account at $30,000. Okay. For some, and again, I don't want this to come off the wrong way, but for some people, that 30,000 is a gigantic chunk, and it's a pretty good chunk of change. Okay. For my kids, younger folks, okay, it's a big chunk of change to come up with to start investing. You don't need that to start. You can start with $5,000, $10,000. Plenty of opportunities to learn out there and learn how to trade with that type of money. Okay, but my trading plan is a bit more aggressive than my investing plan. And let's break it down a bit. When I'm trading, okay, in my trade plan, I'm shooting for about 3% a month. I'm higher theta. I'm a premium seller. That's what I'm looking to get out of it. Okay, that's my trading account. Now, I have built that account from 30,000 up to 400,000 so far. And the only money I put in since I started was an additional little bit of money at the beginning of this year to take us up to the 4,000 even level, so that it was a little bit larger. Other than that, it's grown organically from 30,000 to about 350,000 over the last couple of years. It's great. It's a trading account. I'm not saying that I'm willing to blow that account and see it go to zero, but that's my trading account. Okay, that is not all of my IRAs. Okay, now many of you know that I don't like stocks. I don't trade stocks. I don't even have mutual funds. But my IRAs are different. Okay, I still trade futures. I still trade things differently, but my goals are not the same in an IRA account. Okay, which is more of investing for me. It's growth for the long term. So to me, investing, growth for the long term, trading is generating income in a very short-term basis. Now, that could be 30 days, 60 days, 90 days, but that's a short-term basis. That is not over a year or 2 years of time. But in my IRAs and in my larger accounts that have a little bit different focus, they're not trading accounts. Okay, I'm shooting for about 1.5% a month. So I'm shooting for like 18% a year. It's like half of what my trading account is. So I want to make sure that you guys are clear when you're trading, that is that discretionary trading income or is that your long-term nest egg? Okay. If you're putting in $60,000 into an account and that's your majority of your savings and you want to, pump that up and you want to use some of the strategies that we teach, you absolutely can. However, if that is your nest egg, okay, and that if you lost tomorrow half of that nest egg, would that be severely damaging to you? Okay. If so, shooting for 3% a month might be a little bit reckless for you. Maybe 2%, maybe even 1%, 1.5% a month. Okay. And we're probably going to maybe you can put on those 3% a month trades, but you're going to hedge 1% a month out of that. So you're at a net 2% or something like that. But hedging becomes much more important when that's your primary nest egg or your longer term investment money. If your trading account, now, not that we ever want to lose our trading account, okay, but I'm okay with taking some risk. My kids are okay taking risk. They're in their 20s. They're okay if they have a $15,000, $20,000 trading account because they still have 401ks that they're plowing their money into. They may also be putting into an IRA on top of that, okay, and doing some things there, but that are a little bit more conservative, but still growth oriented. But if it's their trading account that's $15,000, $20,000 in their 20s, and nobody wants to lose the whole thing, but it's okay to take a pretty good haircut. Okay. So when you start to think of all the different hedging strategies and things that are out there, I want you to think about what am I hedging and why am I hedging it? Okay. And I'm older, so if I'm getting close to retirement age, if this trading account that we trade in the Income Navigator service, which is it's a $400,000 account, it's a significant size account. Okay, it is not my largest account. It is not all of my money. I have IRAs. I have a larger PM trading account, as well as some other investments that I do. It's not all my money. Okay, I'm okay taking somewhat of a loss on it. If I lost $100,000 on a pretty significant sell-off here, I wouldn't be super happy. Okay, but I also know that last year I generated over $100,000, starting at $250,000 in cash. Okay, so I know that I can do it again. Okay, but if that was all the money that I had, and I'm close to retirement age, and I'm not ready to retire yet. Okay, but but trading for a living, totally fine. Okay, but that's trading for a living that is different than building my nest egg. And you should have multiple buckets. Okay, when you're starting out and when you're younger, and even when you're in your 30s and your 40s, not still thinking in your 50s, you should be at the minimum taking 10 to 15% of your salary every single paycheck, and that should be plowed into an IRA or your 401k. If you have matching, you should be absolutely putting in as much as you can up at least until where the employer matches. Okay, let them give you a raise by matching. Okay, bucket number one. Okay, so bucket number one is plowing that money into, setting that aside at 10, 15%, plowing that into savings. Make sure you have 6 months worth of savings equal to your salary. If you make $50,000 a year, okay, or let's say $60,000 a year, All right, I want to have $30,000 sitting in a savings account doing nothing, earning crappy interest. Okay, but that's my backup plan if I'm younger. Okay, everybody should have a savings account equal to 6 months of your salary. Okay, so you fill that bucket, automatic invest into it, get it full. Once that bucket is full and starts to overflow, okay, that overflowing should be starting to go into additional investments. Now, off the top, like I said, 10, 15% of your money should also be going into your 401k so that you never miss it. You'll never worry about it. Let it be automatic. If you can do 15 to 20%, I have my kids start at 15. I won't let them do less than that. It's painful when you're a 20-something and your dad's telling you you got to take 15% of your salary and you got to chuck it into your 401k at work and where you get matching. It will pay off for them. They don't like it, but they do it. Okay. If you can do 15 to 20%, do it. Okay. The more automatic investment you can at the beginning, great. Okay. That goes off. You never see it. It goes into your IRA or it goes into your 401k. You get matching. It's in safe investments. It's whatever you want to do there. Okay. The rest of that bucket, after you've filled up your 6 months of salary, okay, that's full. Okay. I've got my 10, 15% going into my 401k. And now I've got additional money that's going to hopefully go into a trading account. Okay. This is where it's not discretionary money, but this is your trading account money. I'm plowing money into my long terms. Okay. I've got my savings account where I need it for an emergency rainy day. If I'm saving for a house, you start to put a little bit of that aside. Okay. But make sure you're plowing into your trading account every single month. The faster you put money into that trading account, you can start to trade. Now, that trading account, though, I'm going to take a lot more risk. I'm shooting for a 0.4% theta. I'm shooting for 3% a month. That's my trading account. That is not my IRA. Okay? My IRA is 1.5% a month. Okay? I have a $1.2 million account. In that account, okay, I'm closer to 2%. Okay, I don't need to generate 3% and be all kinds of risky in a multi-million-dollar account. Okay, that's all good. Okay, I could put that account here and say, oh, hey, I'm making $50,000 a month or something like that, and get all kinds of YouTube hits on some China account. That's not going to do anybody any good. Okay, what we're trying to teach you in the Income Navigator service is I want you to learn to invest. Okay, over here. Okay, but we're trying to teach you to save. Or I'm sorry, to trade. And I want you to be able to trade. And with trading comes having some safety. Okay. Do you want to put a black swan hedge on? If that is your nest egg, then and you're scared to death, then you got to do it. Okay. Do you want to put hedges on every week, every month, every day, whatever you want? Okay. If that is your nest egg, you got to do it. Okay. Well, I can't hit 3%. If that's your nest egg, you shouldn't be shooting for 3%. Okay, 2% is just fine. Okay, or 3% with 1% of it going into hedges is fine. Okay, I just want to make sure that we clarify a bit what's a trading account, okay, and what's investing. What's your nest egg? If it's your nest egg, I don't think I'd be shooting for 3% a month on that, or 4% or 5% or something ridiculous. Okay, my account, the Income Navigator service, is primarily a trading service. Okay. Yes, we do run IRA portfolios, but you know that IRA portfolio is only generating 1.5% a month. Now, sometimes it hits 2%. Okay. And it's great. And with some of the trades that we do, but it's safer. Okay. There's a lot of different safety investments in there. We have a lot of hedges and stuff on. So we're making sure that in an IRA, we're really holding that to where it needs to be. So from a hedging standpoint, I want to make sure that you're hedging. We had a really good training yesterday with our members, and we went through trading some PM accounts and some larger accounts and what the goals are in those accounts. Everybody's goals are different. Okay? You have to understand what your goals are and what the difference is, and what is the difference between investing and trading. We're here to help you make you better traders. Now, can you use some of these techniques as you're investing in an IRA or in your core money that you need to live on, your nest egg? You can, but you've got to take a little bit less risk on that, and you've got to hedge a little bit better. All kinds of ways to hedge. There is no such thing as the perfect hedge. Okay? there is no such thing as the perfect black swan hedge. If the market drops some ridiculous amount overnight, 30%, I mean, there's circuit breakers and stuff, but if it hits a circuit breaker and you try to get out and then it hits another one and you try to get out of some more stuff, by the time you're done, okay, you're going to be reduced to rubble. Okay, you're going to have a problem. I don't care how many hedges you got on. And if you're putting your hedges on at 1 or so delta or 2 delta, ain't going to help you initially. Okay, you're going to really have to black swan hedge. But what I want you to take a look at is if I'm a trader and this is my trading account, you can obviously take some more risk, not unlimited. Okay, you got to be smart in what you do, but you also have to make sure that my focus is what happens if we drop 12% in the market and volatility ticks up a bit. How does that affect my account? And for me, the way it's structured, I'd lose about 20% to 25% in my account. Now, being that I've made decent money in this trading account and I feel I can do it pretty well, I'm okay. Okay. Now, if this account hits $1 million and becomes even more important to me, and I want, when I hit that month, when I hit those larger numbers, 750 or $1 million account, I'm not going for 3%. I don't need to. Okay. What do you need the money for? What are you trying to do? Right now, this is a small account I'm building up, and I don't want it to go away tomorrow. Okay. But I'm also not going to sit there in a bomb shelter and waiting for the world to blow up tomorrow. Okay. I'm going to trade. I'm going to employ risk. I will employ some hedges and some safety as well. I feel that I'm in pretty good shape for that. I've got numerous long puts on in this account. We adjust our trades to turn them into hedges as well. So we put on hedges, we turn trades into hedges. There's a lot of different safety things that you can do. We've got a variety of different trades that we go. Some people are trading the 1122, some are trading the 1121, some people are trading the 1134, some are trading the 111. Okay, it doesn't matter what you trade. You could just trade naked puts, and if you want to be safe, you plop on a couple hedges. Okay, the only difference, and I'm going to give Brian some kudos on one of the things he said, watching one of his YouTube videos that they recently did, and he brought up the point that his hedge is the same thing as basically somebody else putting on a 1121. Well, that far one long put that you have, if you're doing that for buying power purposes, that's one thing. If you're doing that because you think that that's some kind of a hedge, you're better off to just buy the hedge instead of doing it that way. However, most of the time, the 1121 or the 1122 or the 1134 or something like that, most of the time, those are built for buying power reduction as well as a little bit more safety. But the best safety you can buy out there is a long put. And the closer to at the money you buy that long put, the more protection that you get. And we continue to put those on. And then we have some unique hedge trades that we did. So anyway, I wanted to open up today, talk about that. I want you to make sure that as you think about things this weekend and you look at your trading plan, okay, mine's a trading plan. It is not an investing plan. If it is my long-term funds, okay, and I'm going to retire or I'm in retirement age, okay, I don't need, okay, 3%. I don't need 2%. Okay. I may not even need 1.5%. Maybe 1% a month is fine. 10, 12% a year is all good. If you've got a $2 million account, okay, do you need 3%? Can you get it? Certainly we can do it. It comes with risk. Okay. If you can live on 2% a month, okay, which is 24% a year, can you live on $240,000 in gains in that account? So what are you trying to do in that particular account? I just want you to think about it a bit as you go through things to make sure that you understand your risks and what you're trying to accomplish here. All right, so let's jump into our account here. We're going to skip the market today since I spent a lot of time just getting on my soapbox on it. But make sure you know the difference between a trading account and an investing account. And this is a trading account. All right, so this trading account yesterday, our standard income navigator account, we ended the week at 458 delta, 0.11, perfectly delta neutral in my opinion. Anything under 0.2 is good. If we're around 0.1, that's even better. Here, if I can get this negative right now, which is going to be very difficult to do, I feel pretty good about that. Theta 861. We have decent theta 0.2. Okay. 0.4 is in my trading plan, but rarely. I mean, if you're looking at my account here, when am I over that? Okay, I'm at 0.2, 0.2, 0.26, 0.24, 0.21, 19, 2, 2, 16, 19. Okay, I'm not hitting that. Okay, because BP rules the world. Okay, I don't care what my theta is. If my buying power is 50%, I'm not trading. Okay, I'm not putting new trades on, even though I need it for theta or want it for theta. Let's put it that way. I would like to get it for theta. And if I can get up to that theta, fine. What other trades can I put on that gets me there? Maybe I need to adjust my strategies in order to achieve that. Anyway, net lick finished at a new all-time high on Friday. We're up to 413, 407. So we are up 17,859 since the start of the year. So we've managed to put in $17,859 of additional value into this account just by the types of trades that we're doing. You'll see that my buying power dropped significantly yesterday to 226. Putting us after we removed Bill out of the equation, I'm sitting at 44% buying power usage. So I'm not even at 50%. Okay. Yeah, we're not taking boatloads of risk. We have a plan. We're sticking to the plan. You can see that we've only exceeded 50% by maybe a percentage or two on a couple of occasions this year, but really we've been right around that 50% or slightly under for probably 40, 50% of the time, and we're only over it when we're over it by a couple of days when the market's dropping. We did close out $1,315 worth of new trades yesterday. Let's take a quick look at what those were. Let's take a look at the account here, see if we can get into yesterday's trades. So we closed 3 accounts. The first one here was we had a put debit spread expire on the day. It's all good. It's a little bit of a loss because we paid for the put debit spread. So that was a little bit of a loss there. It's all good. It's just part of the deal. We've already taken the naked put profit. And there, the next thing here was we did another 0 DTE trade, knocked out another $250, which pays for hedges or anything else you want to do. So $250 to the good there, 6%. I did do a YouTube video on how I set that trade up. I do trade mostly reversals, which is my favorite way of trading 0 DTE. And we've been pretty good. We're at 100% win rate on those this year so far and 95 last year. All right, premium capture here on a gold 112 as well. We took 96% out of this trade. So we managed to close out a gold 112 naked put. So we closed the naked put out in 49 days out of 60, pretty much right on the money for it. So overall, we're doing very, very well. We've got this thing set up, rocking where we want it to be. Great month so far. We're up 13,573. We're up over 3% in this account. So we've hit our goal, and our buying power is only at 44% right now. And we've got plenty of hedges on. In fact, I just re-looked at the account here a few minutes ago on the weekend just to see where we were. We've got several long put hedges. We've got put debit spreads on. So there's a variety of things. And I'm pretty diversified. If you take a look at my account quickly, I'll give you a little sample of it here if I can. So let's see if we can jump into maybe if I can stop sharing, so if I can get to it. Maybe not. All right. All right, just a quick glance at the account. You can see there are multiple oil trades on using about $53,000 of buying power. Okay, there's also a couple, good handful of ES trades on. There's hedges mixed into these, but mostly almost all 112 trades in a ratio spread in there. Then I've also got copper trades. I've got live cattle trades. I've got a NASDAQ trade that is getting close to the end here. And I've also got a bond trade on. And then I've got $164,000 worth of Bill, the Treasury ETF. in this account. So you can see how my buying power is. It's not all in ES bear trap trades. Okay, it's not all we do. We've got plenty of other underlyings. We're pretty well diversified. In fact, when you look at the total buying power here, it's about 50-50. For the most part, it's about 50% in ES and then 50% in other underlyings. If the markets crash tomorrow, will oil go down? Possibly. Will copper go down? Possibly. Will live cattle go down? Possibly. Will bonds go down? Maybe. Okay. My guess is bonds will go up. People will be buying bonds, moving to safety. And I've got treasury bills. Will those change? No. Okay. So I feel that we've got diversification by underlying. Okay. We've also got diversification by strategy, and we've got diversification by expiration dates as well, and by strikes. All right, if we take a quick look at the IRA account as well, yesterday, very delta neutral, 196 on delta, 288 on theta, 0.12. It's about where our normal theta is, a little bit light. 248, 665, so another new all-time high here as well. So the IRA is at a new all-time high. And you can see this doesn't trade much. There's not a lot of trades happening in here. The buying power rarely gets out of the 30s, maybe to 40 or so here. And right now it's sitting at 44% buying power usage, only because we got some trades on. So as we get some things coming off, we'll be in good shape. And if we take a look at the small account as well, we're sitting just off of, we're $10 away from a new all-time high. And you can see we haven't closed anything yet this month, and we're about to. So in December, we closed quite a bit out, so we were early on some trades. Okay, sitting at a nice BP usage here. This thing is a small account. The goal in this small account is 3% a month. Okay, we've hit it. We had a good year last year. We were up over 40% in this account last year. So again, it comes down to, number one, do you and how do you, see if we can turn this off and wrap it up for you. Do you know the difference between trading and investing, and what is your goal out there? I want to make sure that if we're going to be doing anything here with you guys, okay, that you understand that, what the difference between trading and investing is. If you're investing, it's a little safer, it's a longer term focus, and maybe you're a little bit better hedged. Okay. If you're trading, not that you want to lose your trading account, but it's a trading account. It's discretionary. Okay. Bucket one, your savings. Okay. Bucket two is your overflow from the savings into your IRAs, into your 401ks, and you're plowing 10 to 15% of your pay into those things. And then the overflow from that, when that's full, okay, is stick some money into your discretionary trading accounts and build your trading account. You should be depositing into that trading account every paycheck, okay? And you should try to do it off the top of your head. So if I automatically invest, my savings is full, I automatically have my money going into either an IRA or a 401k or whatever you want to do. On your end, I own my own companies, I own my own businesses, okay? So I have my own retirement things funded through there. But now on a trading account, okay, you should be funneling money into that as much as you can, okay, so that you can build that trading account and you can take a little bit more risk there. All right, so there's my my 2 cents for the weekend here. I hope this was helpful for you. If you like what I was talking about today, click the like button if you would. Feel free to comment if you want to. Make sure it's a constructive comment. I would appreciate it. If you don't like something, you're certainly welcome to comment on it, but at least give me a reason why. And we can talk about it civilly as well. And if you're not subscribed to this channel, go ahead and subscribe to this channel. Okay. And if you haven't deposited any money into your discretionary trading account, get some money into that. We've got some different accounts set up with in our Discord right now. People trading for their kids, people trading for themselves, people trading for their parents. We've got IRAs. I'm running IRAs for my parents. I still don't need to do stocks and mutual funds in there. I can still do futures, but I can do them safely with a lower goal. Okay. It's not rocket science, folks. You just need to put a plan together. All right. I hope this makes sense to everybody. Have a great rest of your day, and we'll see you on Monday. Stay warm out there, everybody, and try to dig out of the snow. Bye-bye.